I get this question all the time right now, always have historically. Obviously, people look for this. Since you did such a good job predicting last time, maybe we can bring out your crystal ball again. Variable, fixed rates, people are deciding which direction to go. Obviously, there's a lot of caveats to that. What kind of amortization, if it's insured, not rental, whatever. But I guess where are we thinking in the next 6 to 12 months, prime is going and where are we thinking the bond market fixed rates are going?
Yeah. So I'll start at the beginning of the year and what I was thinking, and then they'll kind of inform how I think the rest of the year is going to go. So start of the year, we were seeing inflation come down a little faster than expected. So I like to watch core inflation, but more specifically, the 3-month annualized rate of core inflation, because it gives you a sense of like, what's the underlying momentum? So if it's slower than like the 12-month, you can expect that inflation is going to start to come down. And what we were seeing in those 3-month core measures was inflation running at like 1%. Like really decelerating. Like 12-month core was still kind of around, between 2 and 3, but like it was slowing down fast. And now that's why you have core inflation on a 12-month basis back to about 2% as of was last reading April. So we had inflation that was coming down. We have a job market that's pretty weak. So not just in BC where we've lost in total have lost jobs in 4 of the past 5 months, but 60,000 private sector jobs. Across Canada, we've lost 80,000 jobs in February alone, over 100,000 jobs this year. So a really weak labor market, inflation that was decelerating. So in my mind, that was a Bank of Canada that would, at the very least, be leaving rates unchanged and maybe would have to start thinking about lowering rates below. Like they're at the bottom end where they think is neutral for the economy right now, 2.25. Maybe they'd have to go to 2 or 1.75. Then, of course, the United States starts dropping bombs on Iran and the Strait of Hormuz closes and we have oil prices spike above $110. When we fed through like what the oil futures curve looked like after those events into our models, tells us, well, inflation's probably going to spike to above 3%. It was 2.8 most recent reading, headline inflation. The impacts on GDP, so we're an oil exporting country, but this is a supply shock. So all it really does is increase prices. There's no new demand. So this isn't something where oil companies see like, oh, prices are rising, there's so much demand, let's invest more, let's hire more. It's really just a windfall for producers. And more those producers are located outside of Canada. Like the owners are outside of Canada, so we don't necessarily get all of the profits. So there's a mild positive impact to growth, but that gets overwhelmed pretty quickly by the effect of everyone on this call going to the gas pump and it's $2.30 a liter where I am. And when I was in Kelowna, I think it was over $2. So yeah. That hurts consumption, and those effects start to outweigh. So you get this sort of stagflationary effect where growth is a little bit lower than would be otherwise, and inflation's a lot higher. The real question then is, what does the Bank of Canada do in that scenario? In a model, it's very simple. There's a real bias towards fighting inflation in all macro models. So our little computer version of Tiff Macklem raises rates back to 2.75 in the model to quell inflation, which eventually comes down. In reality, I think it's a lot more nuanced. There was a deputy governor of the Bank of Canada, Sharon Kozicki, brilliant economist, unfortunately retiring, so they're losing one of their best people. But she had this great speech right before all this kicked off about how central banks should respond to supply shocks like this. And it's really kind of a simple, intuitive framework. If it's a really big shock that's really persistent, then they probably have to act more aggressively. And if it's a small shock, they can probably look past it. This, unfortunately, is a really, really big shock. It's 20% of oil production that goes through the strait. By most measures, this is the largest oil supply shock since the 70s. And then the other question then is it persistent? Is this going to last a long time? Yes. Can the Bank of Canada look through this? Doesn't seem to be ending anytime soon. From like oil experts I've read and listened to, like this is a pretty pivotal month for oil inventories. I guess a lot of production has been coming out of inventories, but those inventories are depleting rapidly. So we could see oil prices really jump if we don't get some resolution soon. Prices have been basically held in check by just using inventories. So the inflationary effects and like the lingering impacts, like the longer this goes, if you own a trucking company and your costs are going up a lot when you bring, produce to a grocery store or whatever, you could probably, eat those costs for a month or two and not pass them on to stores, but you can only do that for so long. And eventually those prices are get passed on. Then they get passed on, from a grocery store and consumer prices. Then you get this sort of spiral where oil prices start driving all consumer prices higher. And then people see prices at the grocery store and the gas pump and everywhere else rising. They ask their employer, like, I need a bigger wage increase this year. You just get this really difficult spiral that then the bank has to be really aggressive to try and break. And we saw this. This is exactly what happened during COVID. And so the question for the Bank of Canada is they were pretty roundly criticized for acting too late during COVID. They waited about a year to start raising rates when inflation was very clearly rising. That's pretty fresh in their minds. Maybe they want to get some credibility back by being more aggressive this time around and raising rates in the United States, which is also super important for what happens to bond yields here. The Fed has gone from an assumption by markets that they were going to be cutting rates once Kevin Warsh came in, he was sworn in today, to now expecting that they might actually have to raise rates. So all of that, means like even if the Bank of Canada isn't going to raise rates this year, even if they keep rates level, we've seen 5-year bond yields jump significantly. I mean, they touched like 3.4 this week, come down since, but because of expectations that central bankers in both the US and Canada might have to raise rates to fight this inflation. So a lot of what's in the 5-year bond yield right now is pure expectations about monetary policies. Like you can kind of look at any bond yield and break it into two parts. One is what do markets expect, the central bank's going to do? And the other part is like a risk premium. And so part of what we've seen is higher risk. And that's about, I think, 20, 30 basis points if you look at the Bank of Canada's data. And a big part of it, though, is just expectations that banks have to raise rates. So super long-winded answer to your question. And it's like, essentially, I don't know. I don't think the Bank of Canada will raise rates because the labor market is really weak. And the economy is a little bit weaker than I think GDP growth is suggesting. But it kind of doesn't matter, right? Because 5-year fixed rates are already rising significantly just because of expectations. This whole choice between a variable and a fixed, then fixed rates could come down if this gets settled tomorrow and all that expectations for rising rates gets pulled out of bond yields and we're back to where we were pre-war. But if you take a variable rate, you're also risking that markets are right and the Bank of Canada is going to raise rates at least twice this year. So that's why a lot of people are taking a 3-year lately because it's still a pretty decent rate and you can kind of bypass all this uncertainty.
Yeah, I mean, we've been doing 3 years for like 5 years now. It just seems like the best product for the most part. So something you said at the beginning there, so it seems like inflation kind of supersedes GDP in terms of like what Bank of Canada is focusing on because they're in such a difficult position, right? It's like the economy sucks, so you have to lower the rates. But if inflation, starts to run away again, like it doesn't matter what our economy is doing. Like inflation's just going to level anyone.
Yeah, ultimately, their mandate is to keep inflation at 2% over the medium term. That's their reason to exist. So they're always going to have a bias towards controlling inflation.